Welcome to The Explainer. Okay, so you've seen the headlines, right? Everyone's talking about the gold and silver rush. And maybe you're feeling that pull, that FOMO to jump in. But hold on. Is this a real golden opportunity, or is it a super costly mistake waiting to happen? Well, today we're going to cut through all that hype. We're going to give you the real, data-driven guide to making the right choice for your money.
Okay, so let's just dive right into what's causing all this buzz. I mean, look at this chart. The price of silver has just exploded. Seriously, check out the difference between 2020 and today. It's nearly tripled. We're not talking about a small bump here. This is a massive, massive surge, and it's got everybody talking.
And you know what's wild? It turns out that old advice, the kind our parents and grandparents gave us that we probably rolled our eyes at, well, it's been quietly outperforming the stock market for the last decade. That's right, for 10 straight years. Just holding gold has been a better move, a more profitable move than investing in India's top 50 companies. Crazy.
So, okay, everyone's rushing in. But here's the real question, the crucial one. Are they buying it the smart way? Because, and you really need to hear this, making the wrong move can mean you lose a huge chunk of your money, literally the second you buy, before you've even started.
All right, so what's really going on here? What's fueling this massive gold rush? Now, it's easy to think it's just people like you and me, regular investors. But the truth is, there's a much, much bigger game at play, with some very big players making moves. It's pretty much a perfect storm if you think about it. You've got geopolitical tensions flaring up all over the world. You have central banks, I'm talking about countries like China and India, just stockpiling gold reserves like crazy. And then on top of all that, you have these huge growing fears about things like the US national debt and inflation. So when investors, big and small, see all this uncertainty in regular currencies and markets, where do they run? They run to the one thing that's been seen as safe for centuries, precious metals.
And check this out, this gold to silver ratio, it's a really fascinating indicator. The easiest way to think of it is like a fear gauge for the economy. So, historically, the average is about 67 ounces of silver to buy 1 ounce of gold. But today, it's all the way up at 92. That huge jump tells us something really important. It shows a flight to safety, meaning investors are ditching other things and piling into gold, which is a classic sign of high anxiety in the market.
Okay, but before you even think about putting a single rupee down, we need to talk. Let's pull back the curtain on what gold really costs, because there are all these hidden fees that can start eating away at your investment from the very second you hit buy.
Here's a simple question for you. If you invest 1 lakh rupees, how much gold do you actually get? Now, it seems obvious, right? You should get 1 lakh worth of gold. But the answer, well, it's actually pretty shocking. And it all boils down to those sneaky hidden costs.
All right, let's look at where your money vanishes. If you buy jewelry, boom, making charges and taxes can wipe out nearly 16% of your investment instantly. You are starting deep, deep in the red. Now, coins and digital gold are a bit better, but you're still losing money right off the bat. Now look at the last one. Notice how ETFs, that's exchange-traded funds, are the only option that gets you almost the full value of your investment right from day one. All right, so let's break down the two most common ways people actually buy gold: physical versus digital. Let's see what the real pros and cons are.
Look, there's a reason physical gold has been popular forever. You can hold it in your hand, it's pretty easy to sell, and you can even get a loan against it. That's the good stuff. But that feeling of security comes with some very real costs. We're talking high making charges, taxes, the headache and risk of storing it safely, and you always have to worry about its purity. You're basically paying a big premium for that peace of mind.
Now, digital gold. On the surface, it seems like the perfect modern solution, right? It's super convenient and you can invest tiny amounts through an SIP. But, and this is a big but, there are two massive drawbacks. First, the difference between the price you buy at and the price you sell at, it can be huge. And second, and this is the really scary part, this whole space is largely unregulated. Let me be clear. If the platform you're using goes bust, your investment could just vanish. Poof, gone.
Yeah, just look at that number. 5 to 30%, that's the spread. What that means is the second you click buy, your investment could already be worth up to 30% less than what you paid. You're starting in a massive hole that the price of gold has to climb all the way out of just for you to break even. That's a huge hurdle.
Okay, so now let's talk about the paper-based options. These are totally different. They're designed for one thing and one thing only: pure investment. And honestly, they're fast becoming the go-to choice for investors who've done their homework. So what's a gold ETF? The simplest way to think about it is like owning gold on paper. You buy and sell it on the stock market, just like you would a share of a company. What it gives you is direct, pure exposure to the price of gold, but with way more efficiency and much, much lower fees.
But listen, not all ETFs are created equal. You have to pick the right one. So here's a quick 3-step checklist. First, find the one with the lowest expense ratio. That's just the fee they charge. Second, check for low tracking error. That just means you want the fund's price to stick as close as possible to the actual price of gold. And third, look for a large AUM, assets under management. A bigger fund is a more popular fund, which means it's way easier to buy and sell when you want to.
So what about mutual funds? Here's the bottom line, plain and simple. A gold mutual fund is basically just a gold ETF with an extra layer of fees on top. That's it. It's sold as a convenience if you don't have a demat account. But if you do have a demat account, the one you use for stocks, it is almost always cheaper to just skip the mutual fund and buy the ETF directly yourself. You're just cutting out the middleman.
Okay, we've gone through the options, the hidden costs, the risks, the whole shebang. So, after all that, how in the world do you decide which path is actually the right one for you?
So, what's the verdict? What's the best way to buy gold? Well, surprise, surprise, the data says there's no single magic answer. It really depends on your goal and your timeline. Let's break it down. If you're thinking short-term, say less than 5 years, ETFs are your winner for efficiency. But if you're making a big lump sum investment for the long haul, we're talking over 6 years, then physical gold can actually make more sense because the costs average out. And if your plan is to just invest small amounts regularly, like an SIP, then the sheer convenience of digital gold might be worth it even with its flaws.
So that brings up the next big question. How much gold should you even have in your portfolio? Well, a really common rule of thumb is to think of it as a stabilizer. So for example, when you're in your 20s, maybe you start with about 10%. Then as you get older, say into your 40s and 50s, you might increase that to 15 or even 20%. The idea is it acts as a hedge, a bit of a safety net against the ups and downs of the stock market.
Okay, before we finish up, I need to show you one last, really critical piece of history. I know the excitement is sky high right now, but gold's past has a very important lesson to teach us. And this is it. It's so important to remember that gold does not always go up. Just look at this timeline. From 2014 to 2019, they call it gold's lost years. For 5 straight years, the price did nothing. It went absolutely nowhere. This is such a powerful reminder that gold is not a get-rich-quick scheme. It's a long-term game, and it can seriously test your patience, especially if you're the person who bought right at the peak.
So what's the smartest move you can make with all this information? Here it is. Avoid the temptation to go all in with a lump sum, especially when prices are hitting all-time highs. The most sensible, prudent strategy is to use a systematic plan, an SIP. Invest small amounts regularly. This averages out your cost over time and dramatically reduces the risk of being that unlucky person who buys everything at the absolute peak.
So in the end, after everything we've looked at, it really boils down to one simple question you have to ask yourself. What role is gold going to play for you? Is it a prudent hedge, like an insurance policy against a volatile world? Or is it just a speculative gamble, a bet that the price will keep climbing? How you answer that question for yourself, well, that's what will define your strategy and ultimately your success.